Has the S&P 500 really returned 12% since its inception? When are 12% returns only worth 10%? And what's a dead simple way to calculate your investment returns? We'll answer these questions and more on this, the 75th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Hey, I hope you're doing well today. As I record this podcast, I'm actually recording it on June 5th. I tend to record podcasts usually a couple of days before they're actually published. It just depends on what the podcast is. But as I'm recording this, the S&P 500's up, NASDAQ's up about 1%, the Dow is up, and folks are starting to ask the question, and really they've been asking this question, but you started to hear it more and more, is the market overvalued? And I do get a little nervous as we start to see records being set on the S&P 500. I don't change my asset allocation. I don't go in and make big trades. It's just not been my approach to investing. Although it is a time when I'll start to make changes that I've already planned to make, like maybe drift a little bit more towards bonds if that's my plan. And so I thought today we're going to talk about investment returns, how you calculate them. And we're going to talk about 12% returns, and I'll tell you where I got that in just a little bit. But I thought what I'd do is real quick, two things, sort of a money tip of the day and a money tool of the day, kind of wrapped into one. So first, the money tip part of this duo today. The first is, we talk about price to earnings ratios, which is a way to sort of assess how expensive an investment is, how expensive a stock is in relation to its earnings. And I will dedicate an episode, probably more than one, on this topic. I'm not going to dive into it in a lot of detail. But just to give you an example, I'm in Google Finance, and you can pull up the PE ratio of anything real quick. And if I type in, for example, we'll use Berkshire Hathaway. If we type in the A shares of Berkshire Hathaway, it has a PE ratio. It's about 16, I think. Yep, 16.36. That's its price to earnings, right? So if you take its price per share and divide it by its earnings per share, you'd get 16.36, and you're probably familiar with this. You could take another extreme, and let's type in Amazon. Amazon's going to have a much higher PE. Oh my, 512.8. That is a very expensive stock in relation to its earnings, particularly when you compare it to something like a Berkshire Hathaway. And another stock that I own, I don't own Amazon. I'd like to invest in Amazon. It's just too expensive. If it were cheaper or less expensive, I'd invest in Amazon. I love the company. But I do own shares of Berkshire. I also own shares of Wells Fargo. And checking them out, they're around 12, I think, 12.83. That's their PE. But here's the tip of the day. You can determine the PE of a mutual fund as well. And it's very easy to do. And I'm sure there are multiple sources. I always use Morningstar. So if you get the ticker symbol of one of your mutual funds and you put it into Morningstar, it will give you what the PE is, the weighted average PE of that mutual fund or ETF. And I use that from time to time. As I typically invest in index funds, low-cost index funds. If you've been listening to the podcast for any length of time, you know that to be the case. Although I do have some actively managed funds. But when I want to sort of gauge how expensive, if you will, relative to earnings, my investments are, I can't just look at the S&P 500. I don't have all of my investments in an S&P 500 index fund. So I have to look at the various mutual funds that I own. And Morningstar is just a great way to do that. And I'll just give you one quick example. I'm going to pull up a small cap fund that I own. If I can find it, yes, VSIAX. Let me type that into Vanguard, VSIAX. That's the Vanguard Small Cap Value Index Fund. They're Admiral shares. And when I pull that up in Morningstar, and it, of course, gives you a ton of information about the mutual fund, about any mutual fund you'd put in here, or any ETF. And now I got to remember where to find this, right? I'm pretty sure it's under performance. Let me just double check. Oh no, it's under the portfolio tab. The portfolio tab. So again, I'm looking at VSIAX, Vanguard Small Cap Index Fund. They're Admiral shares. And the PE of this fund as a whole, 16.37. Now, Morningstar will also give you the PE of its closest benchmark, also of the category average. In this case, would be small caps. It gives you a lot of other data that can help evaluate how expensive a mutual fund is, like price to book ratio, price to sales, price to cash flow. And, I will definitely put that on the calendar to have podcasts about those because they're really important. But in this case, it's I'm looking at price to earnings. Now, what Morningstar uses is price to prospective earnings, and that's a whole other conversation that I'll save for another time. I personally think that the most important PE ratio is trailing 12 months, TTM. There's a couple of different ways to calculate price to earnings. And frankly, it kind of drives me nuts when folks use estimates of future earnings. I just think that's pointless. But that's a whole other discussion. The point today is you can determine the price to earnings ratio of a mutual fund or an ETF, and it can help you assess just how expensive, if you will, or over or undervalued your investments are. And in fact, if you use the Morningstar portfolio tool, which I do, it can quickly give you the PE ratio of your entire portfolio. So that's the sort of quick tip of the day. You might want to check out your investments in Morningstar. That's one option. The tool of the day is one that I've talked about before, and it's Personal Capital. And I use Personal Capital as a very easy way to determine how my investments are doing in terms of returns. And they have a couple of things. They have one thing that's called the U index. It's YOU, as in your index, your return, and it can calculate it on a daily basis, a monthly basis, whatever, and then compare that to an index such as the S&P 500 or the Dow. You can compare it to a bond index, a number of different things. But the other thing you can do in Personal Capital is they have a performance tab under investing, and you can look at your returns. I'm looking at my return, for example, the last 30 days, my portfolio as a whole is up about 2%. I can look at my returns for an entire year to date, last year. The other thing I can do is I can slice and dice it. So I can look at just my returns, say, for my taxable accounts or my retirement accounts, or I can even drill down and look at my returns for just a single account. Now, for me, for last year, actually the numbers that Personal Capital gives me are not quite accurate, and that's my fault. I had to disconnect some of my accounts that I had previously connected with Personal Capital and then reconnect them, so I lost some of the data. So one thing to note here is it's very easy to connect all of your investment accounts to Personal Capital, but if you want to get a sense of the overall return of your entire portfolio, it'll be important, obviously, to connect all of your accounts. They show portfolio performance last year for me of about 25%, but that doesn't quite factor in, as I said, all of them because I had to disconnect some of them and then reconnect them. So I think my actual performance was around 28%, and that stands to reason. The S&P was up over 32, but of course I have some bonds and other things. I also have some individual stocks. Some did better than the S&P, some didn't do as well. But it's a very easy way to get a rough idea of how your investments are doing. You can check them out at DoughRoller.net/PC. And that'll redirect you to a page where you can sign up for this tool. It's totally free. That is an affiliate link. I will earn a commission if you follow that link and sign up. And if you do, I appreciate your support. You can also always just check out Personal Capital directly at personalcapital.com if you prefer. Okay, on to today's topic, 12% returns. Where in the world did this topic come from? Well, as you may have already listened to it, I did sort of my own assessment of Dave Ramsey's endorsed local providers. That was podcast 69, DoughRoller.net/podcast 69. And as I was doing research for that podcast, I came across some content on Dave's site, his view that one, historically, the S&P 500 has returned 12%, and his view that it will continue to do so. And that's I'd read about that in the past, hadn't really focused on it. It was a surprise to me for a couple of reasons. One, the S&P 500 historically hasn't returned 12%. It's returned 10%. And two, you can just about any other personal finance expert, I don't pick anyone, from Vanguard, from Fidelity, Warren Buffett, Rick Ferry, we've had him on the show. I don't care who you pick. No one that I've ever read other than Dave is suggesting that stocks are going to return over the long term 12%. And I thought, well, that's kind of strange. So I dug into it a little bit, and I found on Dave's site not only the 12% view, but he actually at one point got very, very specific and said, stocks have actually returned, if you go all the way back to 1926. Now, the S&P 500 as we know it today, its inception was 1957. But, of course, you can trace variations of the index back further, and it's not uncommon for folks to start at 1926. So Dave didn't just pick that date out of thin air. That's a pretty common starting point. And what he said was from 1926 all the way up to 2011, he actually got very specific on his site. He said that it's returned, let's see here, the current average annual return from 1926, the year of the S&P's inception, through 2011 is 11.69%. And I thought, that's an awfully specific number, and I know he didn't just make that up. And for days, I was kind of trying to figure out, where does that come from? Where does that come from? Because I know the annualized return is around 10%. I've read it a million times. It's, you can find it repeated again and again on all kinds of very authoritative websites, books, what have you, on investing. 11.69%. Where did that come from? And I was driving one day trying to figure this out. That, by the way, gives you an insight into my life, right? Driving around in my car with 11.69% rattling around in my head, and finally it just, boom, hit me. I know exactly how he did it. And when I got home, raced to the computer. Okay, I didn't race to the computer, but I walked to the computer briskly, and got a data dump of the annual returns of the S&P going back to 1926. It's available online, all the way through 2011. Cut off 12 and 13 because he didn't include those. My guess is he wrote this in 2011, or someone on his team did. Fair enough. And dumped it into Excel and did a quick calculation, and came up with not quite 11.69%. My number was actually off a few hundredths of a percent, but it confirmed, at least for me, how he calculated his numbers. And I actually emailed his company to try to get confirmation. Never heard a response back. Maybe I'll get a response. I don't know. But it turns out his calculation is absolutely correct. His calculation is absolutely correct. 12% calculation. I'll use the 12% number. Just easier. He's rounding up a bit. Fine. And guess what? The folks that say, no, it's 10%, they're absolutely right too. I know. How can 12% equal 10%? Well, we are going to answer that question today, and we're going to do it by playing a game. If you are old enough to remember the old Let's Make a Deal game show, that's what we're going to play today. Except in that show, you never knew what was behind the curtain before you had to choose it. In today's game, I'm going to actually show you what's behind both curtains 1 and 2, and then you get to decide which you'd pick. You ready? Here we go. So behind curtain number 1, we have an investment. We're going to invest $10,000, and we're going to do it for 10 years. And every single year, the investment will earn 10%. Just boring, right? 10%, 10%, 10. No change whatsoever. We'll compound it annually just to keep things simple. And you'll, at the end of 10 years, you'll have, whatever that amounts to be. Now, behind curtain number 2, we have the exact same investment, $10,000 for 10 years. But it's not going to earn 10% every year. Instead, it's going to alternate. In year 1, it'll earn 5%. In year 2, 15. And then in year 3, back to 5. Year 4, alternate over to 15, 5, 15, 5, 15. You get the idea. For 10 years. Now, which investment would you prefer? Now, let's think about this for a minute. We're going to calculate annual average returns. That's what Dave did on his site, average annual return. So what's the average? Well, behind curtain number 1, the average is really easy to calculate. It's 10% every single year, so we know the average is 10%. And we could do the math, right? We could add up the 10% each year. That would equal 100. And we could divide by the number of years, 10. You get your 10%. Well, the other one's pretty easy to calculate too. Sure, we're dealing with different numbers, but 5, 15, 5, 15. We get the pattern, right? It's either 5% below the 10% number or it's 5% above, alternating back and forth. So we know if we did the math, the average annual return would be 10%. It's the same, both behind curtain number one and behind curtain number two. This $10,000 investment, it's going to have an average annual return of 10%. So which one would you prefer? Or maybe you conclude it doesn't matter. I'll give you just a second to think about that. And what's the answer? Well, it depends. It depends if you want more money at the end. If how much you end up with at the end of this 10 years matters to you, then you're going to want to take what's behind curtain number one. You're going to want the 10% every single year. And you may be saying, wait a minute, if they both have an average annual return of 10%, are you telling me that the 10% every year beats the 5%, then 15, then the 5, then the 50? How can that be if they're both have an average annual return of 10%? Well, let's first look at the numbers. It's easy to calculate what's behind curtain number one because it's the same return every year. We can just use a simple Excel formula, right? A future value formula equals FV per N, and then we'll put 10% in as the percentage and a comma, and the number of years are 10 and a comma. And then it'll ask for payments. That will be 0 because we're not going to add to this. And then comma. And the last number is our initial investment. We'll put it in as a negative number so that the result comes out positive. And you get $25,937. That's what you would end up with if you had chosen curtain number one. Now, if you had chosen what's behind curtain number two, 5 and 15, 5 and 15, you'd actually ended up with less money at the end of the year. This was a little bit more difficult to calculate because the percentages change every year, but I just fired up the old spreadsheet and calculated it. And you come up with $25,671, a difference of roughly $250. Not a huge difference over 10 years, but a difference. Now, you might be saying, I know what you did, Rob. You stacked the deck against curtain number two. Instead of starting with the 5%, let's start with the 15%. We'll do 15-5, 15-5, 15-5. And that way we'll kind of get a head start right out of the gate. And then, the magic of compounding will help us propel us maybe even beyond what the just earning 10% will earn us each year. Well, now I tried that. It turns out it's the exact same lower number. Whether you start with 5% and then 15 or start with 15% and then 5 and alternate for 10 years, you still end up with that same $25,671. Sorry. Okay. So now for those advanced thinkers out there, you might be thinking, well, wait a minute, let's really stack the deck. Let's see if we can beat this return where it's 10% every year. Let's front load for the first 5 years the 15%, 15, 15, 15, 15, 15. Then we'll really be out ahead. Yeah, we'll earn 5% for the last 5 years, but that's okay because, again, with the magic of compounding, we'll be so far ahead, we'll come out ahead at the end of 10 years. Well, you're probably figuring out where this is going. Nope. You end up with the exact same number, the lower number, $25,671. So what's going on here? Here's the deal. When you want to calculate return on investments over a number of years, you can't simply use the average, the mathematical average of the returns, because that doesn't take into account volatility. And as we all know, even bonds, but certainly stocks, are volatile. They don't return the same thing year in and year out. And in fact, with the S&P 500, we can have a great year like last year and earn over 32%, but we can have some really bad years and lose 10, 20, 30, 40% or more. So the S&P 500 is really volatile. And a simple average, simply adding up the various returns from year to year and taking a simple average, will not result in the actual return you would enjoy as an investor. Now, that raises the question, well, then how in the world do we calculate it? Well, it's actually pretty simple. You calculate what's called the annualized return. If you want the fancy name for it, it's the compound annual growth rate. Now, here's the deal. If you had returns that were literally identical, like in our example behind curtain number one, 10% every single year, the annual or the average annual return would be exactly the same as the annualized or compound annual growth rate, because there's no variability, there's no volatility. It's the same year in and year out. But here's the deal. As you have more and more volatility, your annualized rate, that is what you'll actually receive as an investor from year 1 through year 10 or year 1 through year 50, goes down as compared to the average annual return. So, all right, let's talk about how you calculate it. It's really easy. So, in Excel, there are plenty of tools that you could find online. Just Google compound annual growth rate calculator, and you'll find more than you could ever want. If you want to calculate it in Excel, it's pretty easy. You just do an equal sign, and then the formula is going to be this. It's going to be your ending value, and we'll use what was behind curtain number 2, $25,671. You'll take that value and you'll divide it. You'll divide it by the starting value, $10,000. Put that calculation in parentheses, and then you're going to raise the result of that calculation to the power of, are you ready? 1 divided by the number of years. In this case, 10. Put that in parentheses, and then you're going to just subtract 1 to turn it into a percent. And if you do that, behind curtain number 2, where we started with 5 and then went to 15 and then 5 and 15, your annualized return is 9.89%. It's actually lower than 10%. So what do I mean by that? What I mean is simply if you started with $10,000 and you earn 9.89% every single year, you'd end up with what we had behind curtain number 2. $25,671. Now, we talked about the variations. What if we started with 15% and then went to 5%, or if we front-loaded all of the 15% and then back-loaded the 5%? It would be the exact same thing. Why? Because the volatility of those returns are the same. We're moving the order, but it doesn't change the volatility when you're looking at 10 years as a whole. So in those cases, each of those cases, the annualized return, what you would have actually earned if you started with $10,000 and ended with $25,671 is 9.89%. It's not the 10% that you'd calculate taking a mathematical average. Now you might be saying, okay, fine. That's not that big of a deal. I mean, it's a little bit less, but 9.89%. I mean, if we're rounding, it's still 10%. Well, that's true, but let's increase the volatility. For example, let's assume that in the good years we earned 35% over this 10-year period, and in the bad years we lose 15%. We're still talking about an average annual return of 10%. Do the math, it still works out to 10% if you're just taking the average annual return. However, what you end up with is a good deal less than the $25,000 numbers we were talking about. In fact, you end up with $19,896. The volatility really matters, and your compound annual growth rate or annualized return is just 7.12%. It's a big, big deal. Volatility will reduce your returns as you compare average returns to what's our annualized or compound annual growth rate. It has a big factor on how you calculate the returns and what you end up with. Now, apologize for the math today. If you're on your way to work, keep both hands on the wheel. Don't worry about the math. You can always try it at home later, or preferably just completely ignore all the math. The thing to remember is you can't use simple arithmetic, simple averages to calculate how your investments are going to do over a number of years. Now, that raises a couple of questions. The first is, so why does Dave use average annual returns? Answer, I have absolutely no earthly idea. Don't know. I emailed him, didn't get a response. Maybe you can email him and ask him. Maybe he'll respond to you or someone at his company. I don't know. I don't know why he would use average annual returns. It turns out, by the way, that there have been a lot of articles written about Dave Ramsey's 12% returns, and at least all of the ones I've read across many, many sites have been very critical of the way he calculates that return. Don't know why he does it that way. Now, I think the more important question is, who cares? I mean, let Dave calculate the returns he wants to calculate any old way he wants to. What do we care? How does this help us? What's the point? How can it help us make the most of our money? I am so glad you asked. I've got 6 ways that it should matter to us, that it does matter to us, that I think it matters to you. You ready? Here we go. Number 1. First of all, we need to be able to I think, speak and think through these issues intelligently. If you're going to, for example, hire an advisor, maybe you do want to hire a Dave Ramsey endorsed local provider, and you want to reach out to some and interview them. You're going to be having conversations with them. You may this whole 12% thing may even come up, and it's a fair question. You need to be able to speak intelligently about it and understand and ask them these questions. How are you calculating returns? Do you think average annual return is the right way to calculate it? Do you agree with Dave's method and the way he's calculated 12%? Because under compound annual growth rate, the S&P 500 since 1926 has only gone up an annualized basis of 10%. That's a big difference. So you'll be able to speak intelligently if you are going to hire an advisor, and you can better understand how these returns are calculated and, more importantly, how they should be calculated. That's the first reason. The second reason is, compound annual growth rate comes in handy for a lot of things other than just debating the S&P 500. In fact, in my very next podcast, I'm going to be covering the issue of whether your home, the one you live in, not rental properties you may own, but the home you live in, whether it is a good investment or not. And I've decided to bear all. I'm going to walk through our first home, all of the numbers. I'm going to lay it out there, and I'm going to calculate the compound annual growth rate so that we can then compare that investment, if you want to call it that, to other options. So the compound annual growth rate has a lot of applications beyond just a friendly debate about the S&P 500. Third reason it matters is that it really underscores how volatility affects your returns. As we saw, the more volatile a stream of payments is, the more volatile your returns are from year to year, it really has an impact on the bottom line. It makes a big difference in real dollars that you end up with at the end of the day. And just this, in the example we looked at, over just 10 years, earning 10% every year, almost $26,000. But if you take good years of 35% and bad years of minus 15%, the actual dollars you end up with at the end of 10 years drops below $20,000. So volatility matters. Now, sometimes we can take advantage of volatility, because with volatility comes higher returns, right? Stocks are more volatile. That's why we expect higher returns from them. And there are ways that we can harness that volatility without experiencing some of its downside. And what's that called? Well, it's called effective asset allocation. And we've talked about that at length. I'm not going to go into it in detail now. You certainly can get my views on asset allocation if you'd like to, and you can check that out in an older podcast. And here it is, like a couple of them. One is podcast 41, DoughRoller.net/podcast 41. That's where I talk about Warren Buffett's asset allocation. And then in terms of creating an asset allocation plan, you can check that out, podcast 25, DoughRoller.net/podcast 25. Okay, so back to today's topic. What else can we learn? Well, this debate about what stocks will return in the future, it's not just a friendly debate. It really matters. You say, why would it matter? Well, think about retirement. One of the questions you're going to have to answer, both as you plan for retirement and when you enter retirement, is this: how much can you safely withdraw from your investments without incurring a significant risk of running out of money in retirement? Now, if you listen to my interview with the folks at Vanguard, you know that the sort of general rule of thumb is 4%. You can check that out at podcast 46, DoughRoller.net/podcast 46. That's the general rule of thumb, 4%. Now, what does Dave say? He actually talks about an 8% withdrawal. That is a huge difference. Of course, if you're expecting to earn 12% on your investments annualized, well, then 8% might seem okay. You can leave 4% in your accounts to grow to cover inflation, and you're left with 8% to spend. The problem is, if that 12% doesn't turn out to be correct, you could run out of money in retirement. And so while at one level, it may just be a friendly debate about future returns, it's actually quite important for planning purposes. This is a decision you have to ultimately make. And I got to tell you, other than Dave, I have found no one that suggests anything near an 8% withdrawal rate. In fact, what I generally see is 3 to 5%. 4% comes from what's called the Trinity study many years ago that kind of started all this line of thinking. But some now today say it's actually lower than 4% because interest rates are so low on fixed income investments, and the view that going forward stocks won't return what they did historically. Now, again, we can debate that issue. There could be friendly levels of disagreement. You may say, I think 3.5% is a good number. Others may say 4.5%. But I've seen no one other than Dave argue that an 8% withdrawal rate is a good number in retirement if you're planning to, say, retire over, say, a typical 20 or 30-year period. No one. So what we expect stocks to return in the future is more than just a friendly discussion. It really, really matters. Now, two more things, items 5 and 6. Number 5 is, and by the way, they both relate to this withdrawal rate. Number 5 is this: costs, as we all know, affect returns. So even if we just assumed for a moment that over the next period of years, whatever, 10, 20, 40 years, the S&P 500, in fact, on an annualized basis, returned 12%, we still have to factor in costs, because just because the S&P 500 returns 12% doesn't mean we get to receive 12%. Now, if you invest in low-cost index funds like a Vanguard S&P 500, then you are going to receive maybe not 100% of the S&P 500's returns, but it's going to be awfully, awfully close because fees are so low with that kind of investment. However, if you're using commission-based brokers, expensive fee-only advisors, or expensive actively managed mutual funds, then even if the S&P 500 returned 12%, you would be very unlikely to actually receive 12%. And in fact, you could receive substantially less than that. And so that's very, very important. Investing costs matter, and they need to be taken into account. It's not enough to simply say the S&P 500 did return X or we think it will return Y. You have to look at costs. And the final thing, the final reason this matters is that, again, even if we were to assume that the S&P 500 were to return annualized, compound annual growth of 12% over the next number of years, would you actually receive that return even if you did invest in low-cost Vanguard or other index funds? Probably not. Why? Because it's unlikely, particularly as you near and enter retirement, that you're going to invest 100% of your money in an S&P 500 index fund. The volatility is probably going to be more than you can handle as you near retirement and as you enter retirement. In fact, the vast majority of advisors that I've read and books that I've read and folks that I've interviewed on this show say as you near retirement, you need to have an investment portfolio that becomes less volatile. So you end up investing more and more in bonds. And so, there's no one right answer, but I generally see folks in somewhere in the 50-50 range, maybe 60% stocks, 40% bonds, maybe 70% stocks, 30% bonds. But I don't see people saying, in retirement, let's invest everything we've got in the stock market. You simply can't handle the volatility because you need a portion of that money to live on. And so asset allocation and reducing your risk will reduce your returns. You won't receive the benefit of the returns of the S&P 500, but what you will get in return is a less volatile portfolio. And that's what most people in retirement need. So this stuff really does matter. It's not just a friendly discussion and difference of opinion and gee whiz, one guy says this and someone else says that. It really, really matters. Now, I'm not here to tell you what the S&P 500 is going to return over the next 40 years because I have no earthly idea. I can tell you that for my own planning purposes, I'm generally assuming two things. One, that I'll be able to withdraw roughly 4% of our nest egg in retirement. Yes, it could be a little less, it could be a little more, but I'm using for planning purposes 4%. And two, that I want to have enough money so that can be flexible. I don't want to start at 4% and then increase that amount by inflation every single year and have to depend on that kind of money year in and year out. I want to have the flexibility to perhaps withdraw less in some years if the market is really down and maybe a little bit more in the good years. So those are the assumptions that I'm using. And yes, they do not assume that the stock market's going to return on an annualized basis 12%. Why? One, because it hasn't in the past over the long period, in my opinion. And I just don't, it'd be great if it did going forward, but I'm not going to rely on it. I don't think it likely will. And I'd rather prepare for the worst and hope for the best. And if it turns out better than that, and maybe I can spend 5% a year or whatever, terrific. But I'll be prepared if it doesn't work out that way. So there you go. Hope you enjoyed the show today. If you have any questions about this, or you want to throw out your own opinion, would love to hear from you. Just email me at dr@DoughRoller.net. You can get the show notes to this episode. I'll include links to Dave's pages and other information on the historical returns of the S&P 500 and what folks think in terms of what we can expect in the future in the show notes. You can check those out at DoughRoller.net/podcast 75. And lastly, if you haven't already, subscribe to the newsletter. It goes out every Saturday, DoughRoller.net/newsletter. You can subscribe. It goes out, as I said, just on Saturday. I pack it full of information to help you make the most of your money. Hey, until next time, remember, the best thing money can buy is financial freedom.